My name is Jake, welcome to the channel. In today's video, we're going to do a review my pie video where I review subscriber portfolios. I can't believe it, but it's been 4 years since I've been doing this. This is the 70th video of this series. I'm excited to share that this video is presented by Snowball Analytics. Snowball Analytics is a tool that I use to analyze my dividend portfolio. You can check them out with the link in the description below and use promo code DGI to get the very best pricing. So here really quick before I dive into the portfolios, I want to share a brief update on where we're at. So I've been mentioning these last couple of months that we're going to be taking a little bit of time off from, taking a break from YouTube. And I've been thinking about what I would like to do in the time while we're traveling. So we're going to be taking a cruise from Orlando to Barcelona, and then we're going to spend about a little over 2 months in Europe, going through Austria, France, Germany, Switzerland, Denmark, just doing a big road trip for a little over 2 months. If you don't know, my wife is from Germany, from northern Germany. I lived in Germany for almost 10 years. And so we're going to go and see a bunch of things that we saw before. And I was contemplating whether or not I wanted to take a true break from YouTube and just not upload at all for like 3 months. But then I realized, if I took 3 months off from YouTube, it's going to really hurt the channel. And it's kind of one of those, it's kind of a crossroad where I basically stop doing YouTube or I keep doing it. Because if I were to take a 3-month break, it basically would set me back. It would be very difficult to get back into it. And so I decided, and I've read a lot of your comments on some of my videos these last couple of months where I've kind of hinted towards this. I'm really kind of at a crossroads where, what do? Do I completely stop making videos? Do I just take 3 months off? Like, where am I at? So what I decided was, well, maybe there's a kind of a middle ground where I can make it work, where I can make videos in advance and have them uploaded while we're traveling in Europe and moving back from Austin up to Utah. If you don't know, we travel between Austin and Utah. And so what I was thinking, why not have kind of like a mini series while I'm gone that I can record in advance, and I can upload those while we're traveling, because I'm not going to bring my mic and my computer, my big computer and everything while we're traveling. So I'd have to do this in advance. It's going to be a lot of work. But what I was decided to do was I'd like to ask all of you to send questions to me, send it to me via email. I'll have the email pop up here on the screen and in the description of the video. You can send me an email with your questions. And what I'll do is for the next 3 or so months, I will answer one question a week, and I will touch on where we're at during that week. So I'll give you an update. I'll do this all in advance because I have the dates and everything of where we're going to be at. So for the next 3.5 or so months, once we leave, I'm going to give an update on where we're at that week, what we're going to see that week, as well as I'm going to answer one question. And I'm only going to be able to do this if you send me your questions. So please send me your questions. It's going to be about 15 weeks. So there's a really good chance if you send me your question that I will actually answer it and make a video out of it. So please send me your questions. It can be about dividend investing, the FIRE movement, investing strategies as a whole, real estate investing, anything, if you know my history, my past, my story, or if you're just interested in learning more about me or my wife and I, how we reached FIRE and, lessons learned, anything that you would like to know, send me a question and I'd be happy to make a video on it. And please don't send me a novel of an email. Send like 1 or 2 paragraphs, like 5 or 10 sentences, nothing too long, something short and sweet, something that I can address in a pretty brief video. But yeah, it'd be really cool if you could send me an email, and I'd love to make a video on your question. In today's review of my pie, we're going to take a look at a question from a 26-year-old here in the United States, and then 3 portfolios. The first is from an 18-year-old here from the US, the second a 35-year-old from Scotland, and then the third a 45-year-old from the United States. And as always, everybody, the timestamps will be in the description of this video, as well as the portfolios will be in the description as well. And as always, everybody, Please don't take what I'm saying as financial advice. This is just merely for your entertainment. All right, let's take a look at the question here. Is from Robert. He writes, "Hey Jake, I've recently gotten a very lucrative full-time travel job that allows me to target a very aggressive investment of about $12,000 per month. I just paid off all of my debt and really got going investing at the beginning of the year. My portfolio is currently 50% in SEHD, 50% in DGRO with about $32,000. Crunching the numbers, I believe I can retire in 5 to 8 years. I'm not entirely sure what it will look like yet, so I'm remaining flexible on my plans. I'm only 26 years old and I don't have a house yet. I figure when I get to the point of feasibly being able to retire, I'll still work an extra year or two to buy and pay off a house. I've watched a lot of your videos, including your retirement time horizon portfolio videos. My question is, do you think it would fit my situation to utilize a 0 to 10 year portfolio even at my young age? What do you think would be a good satellite to add to help me achieve my goals? Thanks for all the content and congratulations on your retirement, Robert." Well, Robert, first off, thank you so much for sending over the question here. And it sounds like you are a follower of the channel. Sounds like you're following what I like to call the simple path to wealth with dividend investing, which was inspired by J.L. Collins, who wrote The Simple Path to Wealth, focusing on, more of a traditional the FIRE movement with the 4% rule and the total U.S. stock market. I adopted what J.L. Collins said in his book and applied it to my own approach of dividend investing, where you invest into SHD and DGRO. You start there, and then based off of your time horizon, you then adjust your allocation. Now, the thing here that I think you're spot on is time horizon is all relative. If you're in your 50s, you have a time horizon that's probably much shorter. If you're planning on retiring, maybe in your late 50s or early 60s. Time horizon is not subject to your age necessarily, but rather when you plan on living off of your dividend portfolio. Now, you're very unconventional where you're 26 years old, you're looking to retire maybe in your 30s, right? So you want to invest kind of like somebody who's in their 50s, but not necessarily. You want to approach this differently. The mainstream way of looking at this is everyone in their 20s, everyone in their 30s has to invest a certain way in their 401k, and that's it. That's the end of it. When I first was learning about investing, I looked at this conventional wisdom and way of thinking and thought to myself, wait a second, that doesn't really fit to what I want to do. And if I do that, I'm not going to be able to do this, meaning retire earlier. So it really just comes down to understanding what situation you're in. So to answer your question, yes, a 0 to 10 year portfolio time horizon could fit you even in your 20s, but there's a couple of things that you want to make sure that you're looking at and understanding. So you're 26 years old, you're not married, you don't have kids. Life can change very rapidly from age 26 to 30 to your mid 30s. I look back on my own experience. When I was 26 years old, I moved to Germany and my entire life got flipped upside down. I had no idea that I was going to go down the path that I went, and I could have never seen that coming. And so what I would highly recommend to someone like you who's in their mid-20s is allow for a big margin of error. You're going to have plans, and those plans are not always going to go to plan. So I would have a strategy that incorporates more flexibility. And what I would recommend you do is take a hybrid approach. I would have a large percentage or half of your portfolio in SHD and DGRO at this point in time. And I'd have the other half focused on growth because you don't know what's going to happen. You might get tired, sick and tired of traveling, and you want to settle down, and you might have to settle for a job that pays less. Okay, and so what I would recommend to someone like you or anyone in your situation is opt more for flexibility because you don't have everything figured out just yet. So I would have my portfolio about 50 or 60% of my overall portfolio, and the money that I'm investing, I'd have that allocated to SEHD and DGRO for now. And I'd have the other 40% invested into a growth ETF like VUG, VGT, or SCHG, one of those, or a combination of a few of them. So your focus there is your buy and hold with SCHD and DGRO, but you're allowing for flexibility, and you may want to rebalance. You may want to buy a house. Your life goals may change. And by keeping it flexible and giving yourself options, it makes life a lot easier, and you'll have a lot less regrets, in my opinion, because you're not going to have all the answers. And so you have to kind of just plan for the unthinkable, because the unthinkable always happens. I can't tell you how many times Murphy's Law has applied in my life. When something can go wrong, it will go wrong. And so just understand that that's the reality that you're probably going to face. You may get lucky and everything may turn out the way you plan it, but I would say it's probably not going to be that way. And that's completely fine. That's life. You should be enjoying your life and not, that should be your focus. So enjoy it. You're setting yourself up for your success. You're investing a lot. I would say, I would ride this gravy train for as long as you can. $12,000 a month is a lot for a 26-year-old. As you get older, you may not be able to do this for much longer. And so I would definitely take advantage of it as long as you can, because it's very possible, you're in a travel job. What if we get hit by a major recession and you get laid off? And you have to find a new job and you're making $6,000 a month, $4,000 a month, right? So you want to, and maybe that's why you're investing for FIRE, because of the uncertainty, right? So that's some of the things that I would, keep in mind. I would keep your expenses low, but yeah, keeping it simple with your portfolio. When it comes to satellite positions, while you're traveling and while you're busy, I probably would just do ETFs. And maybe if you wanted to pick a few handful individual stocks that you really like a Costco, a Microsoft, or something like that you really enjoy, or you're, a consumer of something that you like. But I would keep it very simple. In my opinion, I would just stick with ETFs, but there's nothing wrong with individual stocks as long as you limit your risk. Don't have more than 5% in a single, individual stock, and I think you'll be fine. But in my opinion, you don't want to, neglect your retirement accounts like a Roth IRA or a 401k. You may want to consider taking advantage of those as well. And also, one thing that you're going to want to understand is what is going to be your anticipated expenses. Now, this is the hardest part because you don't know, and this is what I'm talking about with being flexible. So what I would encourage you to do is run a hypothetical scenario. Well, in 10 years, assume that you're married, have 1 or 2 kids, and then go look and see what the healthcare costs are going to be monthly here in the United States to, afford healthcare while you're not working, right? But maybe you're working part-time, you can get health insurance that way. But, and understand how much is daycare. Are you going to homeschool? Are you going to put them in daycare? Are you going to pay, understanding all the factors that are, all the expenses that are going to come your way, you might be shocked. You will be shocked that things are more expensive than we think. And we have to also not forget is inflation. Right? You want to make sure that you're using an inflation calculator, because the reality today will be very different in 10 years. Things will cost more. So those are the things that you're going to want to take a look at. But for now, I think you're doing the right thing. All of those other things that I just mentioned, that's the nitty gritty, right? That's what you're going to want to focus on as you get closer to retirement. But for now, what you want to focus on is keeping it simple. Have your portfolio where you can stick to it. You don't have to change it and get emotional as the market goes up and down. Focus on what you can control. And as you get closer to retirement, treat it like a target date fund as you adjust your allocation as you get closer to your goals. That's where the time horizon comes in. And then all those fun other things will figure themselves out, right? Life will happen. But that's what I would recommend. Keep it simple. I would incorporate a growth portion to your portfolio to add flexibility. But yeah, Robert, I hope that helps. I think you're in an incredible spot. I'm rooting for you. I hope that it works out for you. And thank you so much for sending over the question. All right, the first portfolio is from Ian. He writes, "Hi Jake, my name is Ian. I'm 18 years old, preparing to start college. I'm currently working at a high-end restaurant in my area and make pretty good money as a part-time employee, making $25,000 a year. I wanted to share the links to my dividend growth portfolio and Roth IRA with you." I believe starting these investments early in life will help set myself up for retirement, ideally around 45 to 55 years old. While I know my portfolios aren't perfect, I still get a bit confused about time horizons. I understand that for younger investors, low expense ratios and lower dividend yields are generally better, so I'm focusing on those factors. I really appreciate you taking the time to look over them. There's no need to feature this on your YouTube channel unless you find it helpful to explain something for your audience. Best regards to you and your family, Ian. Well, this is, Ian, thank you so much for sending over the email and your portfolio. Yeah, I think a lot of people are faced with this, right? The time horizon question is one of the most important things, and that's why I talk about it so much on my YouTube channel, is I really struggled with understanding how to invest based off my investment time horizon, and it comes into, ties into a little bit of what I was just talking about with Robert and his question, that if you want to live a normal life as one would define it by social norms, right, where you retire at the age of 65, well then, yeah, you max out your Roth IRA, your 401k, and you live your life, right, and you focus on that. If you want to be different and you want to retire earlier, well, you have to think differently, okay, and you're not going to get that type of thinking, and that, you're not going to have a lot of people talking about that because that's not the norm. And so for me, it was kind of counterintuitive. Like, I thought the only way to do it was to max out my 401k and Roth IRA. But then I thought to myself, but wait a second, I want to retire before I'm 59 and a half. How does that make sense? And so I felt kind of like stupid thinking I'm doing this wrong. But in reality, I was just in a different time horizon. I was in a different situation. So you got to do what's right for you, and don't immediately think that following the herd is always the right choice, especially if you want to choose a different path in life. All right, so Ian, let's take a look at your portfolio. So you have about a 25 to 30 year time horizon. So that means you're going to be working quite a while, and the likelihood that things are going to change in your life are very high. You're just starting college. Your trajectory in life may change and pivot entirely after you graduate college, you get married. You haven't yet experienced all of these wonderful things, in life where life kind of takes you down a different path, right? When I was in my mid-20s, I went to Germany, and I was originally just going for a study abroad, but I ended up staying much longer, and it changed my entire journey in life. And so just account for the fact that you don't have all the answers, and understanding that you don't have all the answers, you want to make sure that you're approaching this complex topic. It is complex if we make it complex. So let's focus on keeping it simple. Let's focus on keeping your investing strategy simple so that it's not confusing and difficult. Okay, so right off the bat, I can see that you're focused on the core and satellite. So you follow my channel. I think this is great. This is a great start. You have a pie here of stocks and ETFs. Let's first take a look at your ETFs, which is 60% of your overall portfolio now. So in this slice, your core ETFs, you got SHD, DGRO, and you got VYM. All of these ETFs are absolutely fine. I think, with your time horizon, you probably could lower VYM a little bit. This is a little nitpicky. You could probably put VYM at like 10%, and then you could put DGRO, at a higher percentage, like at a 50%, right? And then what you would want to do is you would want to then treat this kind of like a target date fund. You could leave, SHD at 40, DGRO at 40, and VYM at 10 for the next 20 years. And then just leave it like that, let it do its thing, focused on your contributions, and set it and forget it. And then as you get 10 years, 5 to 10 years before you reach your goal, then you adjust this like a target date fund. But for the time being, for the next 20 years, especially while you're going to college, you could set this up, automate your contributions, and forget about it. That's the simple part, okay? Now, with your stocks, let's see what you got here. You got a few slices here. You got tech, you got Salesforce, Snowflake, and Cisco. Now, you're very concentrated in these three individual companies. I like these companies. Would I invest this much into them? No. So let me pull up the calculator here. You got 34% times 35. So you got like 12% in those three companies. And in my opinion, unless you're Charlie Munger and you have an entire team behind you, you probably shouldn't be so over-concentrated. Rest in peace, Charlie Munger. Now, Charlie Munger really was an advocate for, diversification is for idiots, but unfortunately for all of us, we are idiots and we don't have insider knowledge. We don't have a massive team behind us, so we should be diversifying. And Warren Buffett actually has talked about that, whereas if you don't have the competence or a team behind you and the understanding how to invest into individual stocks, you should greatly diversify. And that's why he talks about investing in the S&P 500 for most people. Now, if you're going to invest into individual stocks, the first thing here that I would say is limit your downside risk to no more than 5% in an individual stock. Who cares if, Cisco or Snowflake's doubles? That's cool. What happens if they go to zero? What if there's a scandal? What if the unthinkable happens and it goes to zero? That's going to hurt a lot more than potentially doubling your money. So that's at least how I view it. So I would limit your downside risk. When looking at your energy slice, you got Exelon Corporation. I think I can't remember where this is at. Is this the West Coast where they're at? Maybe somebody can let me know where they're located. For some reason, I think of, or is that Excel that's in Denver? I can't remember the energy company that I had. But at 5%, that's fine. Financials, you got SPGI and you got JP Morgan. I think that's good. The thing is you got 7.5% in both of these, also above the 5% threshold that I would personally recommend. Here in your discretionary, you got Williams Sonoma, JD, Starbucks, and Darden. Okay. All right. So let's see here. And I think you said you were in the hospitality industry. You were working at a restaurant. Okay, cool. You got consumer staples, Costco, and Pepsi, also at 10%. Okay, so when it comes to the individual stocks, I don't really have an opinion unless, when it comes to individual stocks, you want to understand which companies are growing faster. If a company has a higher yield, they're probably growing slower. This is universal in most cases, not always. If a company has a lower starting yield, it's generally going to be a higher dividend grower. So a higher dividend grower would be better for your time horizon. And as you get closer to living off of your portfolio, you could adjust your allocation percentages. So when looking at the portfolio here and zooming out, I actually realized that I did make a mistake here when mentioning the 5% here. So, you have a high allocation into CRM in these, and they're, allocated higher in this slice. But this slice is only 40% of your overall portfolio. So I actually need to take a step back and kind of correct myself. And this is not as egregious as I made it sound, because you only have 40% in this slice. Yes, those individual stocks represent a higher percentage, but the actual slice is lower. So I need to backtrack what I just said. This is not as bad as I just mentioned. But what I would recommend, to keep it even simpler, what I would recommend you do, especially while you're first starting out and figuring out your goals, I would increase your core ETFs to 80%, and I would decrease the stocks to 20%. And I would start there. And as you get more comfortable with your strategy and your goals, then you can readjust them going forward. But that's what I would recommend going forward for your portfolio based off of what you've told me. Now, looking at your Roth IRA, this is your tax advantage account. You have a large percentage in VGT at 65%. You have VUG at 20% and VXUS at 15%. VXUS is the international ETF. This is everything outside of the United States. Now, I like this and I don't like it. The reason why I like it is you're more focused on growth. What I don't like is there's quite a bit of overlap. I think it's not necessary to have VGT and VUG at such a high allocation. What I would recommend is I would probably more equally weight these if you're going to have both of them. Or in my opinion, what I prefer is to add VTI, the total US stock market, to get more broad exposure to the overall market. And that's how I do it in my Roth IRA. I have VGT, VTI basically at like 40%. I have VXUS at 10%, and I have VNQ at 10%. That's what I have in my Roth IRA. I've had that for the last 5 years, and I'm happy with that. Now, you have like a 40-year time horizon. I think this is This is fine. It's a little bit nitpicky, but I would probably change this up a little bit. I probably would lower VGT, and I would probably add like a VTI or a VOO, S&P 500. And you'll still have overlap with those, but I don't like having 65% of your Roth IRA in VGT. It's just too much in technology. I'm not the biggest fan of that. I would diversify a little bit more, and I would have more market exposure. And you can easily accomplish that by either including VTI, total US stock market, and reducing these others, or even, something to that effect. That's what I would recommend. But I like this because you're focused on growth, and what you can do is in 40 years, growth will greatly outpace slow dividend stocks when it comes to compounding over a long period of time in almost every case. And then what you can do is you can rebalance tax-free, buy a house, buy more dividend stocks. It gives you a lot of flexibility. So I do like that. So Ian, thank you so much for sending over your portfolio. I think you're off to an amazing start. You're 18 years old. You have a lifetime ahead of you. Keep doing what you're doing. Focus on what you can control and enjoy the journey. All right, let's take a look at the next portfolio from Greg. He writes, "Hi Jake, I was wondering if you'd be willing to take the time and have a look at my portfolio of 12 individual stocks and provide your feedback. I'm 35 years old and live in Scotland. I've just started back investing in stocks after focusing on my crypto portfolio for the past 4 years. I'm currently only investing a small amount into this portfolio, around £50 every week. The portfolio is held in an ISA on Trading 212. The aim of my stock portfolio is for growth and not for income. My time horizon with this portfolio is forever, looking to actively manage it throughout my life. My portfolio in order of a percentage allocated." And so this is a growth portfolio, not an income portfolio. Okay, you can probably tell who I'm influenced by with this portfolio. If you need any more info, or if I forgot to add anything, please let me know. Also, thanks for providing a lot of useful information on your channel. I enjoy watching. Kind regards, Greg. So you probably know who influenced my portfolio. So I don't, interestingly enough, I used to consume a lot of dividend investing content on YouTube. I kind of stopped watching a lot of different creators, mostly especially dividend creators. I stopped watching a lot of dividend creators because I didn't want to be subconsciously influenced by other creators. I wanted to make my content original and not have it be influenced by others. And for better or for worse, that's something that I've chosen to do. I've done that. I haven't watched a lot of dividend videos for years. And it's, and I know who you're talking about. Most likely you're talking about Joseph Carlson, right? Well, he's the one that I used to, years ago, he'd always talk about Texas Roadhouse. Now, that's who I'm assuming you're talking about is Joseph Carlson. Now, I haven't watched Joseph Carlson's channel in probably 3.5 years, give or take. Now, Joseph Carlson actually inspired me to, he was one of the many that inspired me to start a YouTube channel back in 2019, but I haven't watched his channel in three or 4 years, but I still love, dividend investing and the FIRE community content here on YouTube. I consume more FIRE investing community, FIRE investing content than dividend investing content as of late. And that's just, the evolution of how my interests have changed. So fun fact, just if you cared, it's not something that you asked. But so with that in mind, I'm not really a growth investor, and I wouldn't, say that I'm the best person to ask this question, but I can share I have opinions, and I'll share my opinion on it. So when it comes to growth, I think the best thing about growth is it gives you the opportunity to do more with your money, right? If you're on, how can you turn $50 into $100, whether in 5 years or 10 years? And I've never been a really good stock picker. I've had a few good winners. Costco, I doubled my money basically on Costco. I had, a few others that I've done very, very well. My wife invested into Netflix and almost 4x'd her money in Netflix. I wish she would have invested more. I've been better at growing my, investing for growth with ETFs. Like in my Roth IRA, in the last 5 years, my Roth IRA is up about 100%. And I just am better in investing into ETFs than individual stocks. So with that in mind, I'm going to share my thoughts. Amazon, I really like Amazon. I'm a user of Amazon, Prime user. Costco, I go to Costco almost once a week. Just kind of how I love Costco. Microsoft, I have a PC. Google, I use Gmail and YouTube and all that good stuff. So a lot of these companies, Booking, Holdings, MasterCard, Meta, these are more consumer-facing companies. Except for S&P Global, you probably don't use them. But all the others, you probably have used, and if you've traveled to the States, you've probably been to a Texas Roadhouse. So the majority of these are consumer facing, and that's why you're investing in them. And I like that idea. And so you probably already know what I'm gonna say if you're a follower of my channel, but this is what I would recommend. You got what, 12 companies here. What I would recommend is I would have each of these allocated at 5%, no more than 5%. Limit your downside risk, limit your emotions, put them all at 5%. And 5 times 12 is 60, okay? So 60% of your portfolio is in individual stocks. That's great. Why not consider adding 40% into 2 or 3 growth ETFs? Some of my favorite growth ETFs are VUG, VGT, and SCHG. By doing that, you're having a combination of growth ETFs, regardless of what the market does, and you're also still getting exposure to these great individual stocks. But you're limiting your risk. And that's what I would recommend you consider and anyone else watching this video. What I've learned, I'm turning 39 this year. I've lost a lot of money in the stock market. I've made a lot of stupid, foolish mistakes. What I'm sharing with you today is lessons learned from touching the hot stove over and over again. I truly believe that you don't know what kind of an investor you are until you've experienced a true bear market and you've lost money. That's when you learn and understand what kind of an investor you are. I didn't experience the dot-com bubble. I experienced the great financial crisis, the pandemic, and all these corrections along the way. But I learned for me, it feels a lot worse to lose money than it feels good to make money for me. And I understand that. I hate to lose money more than I like to make money. And so that's why I share what I share on my channel. And you may be the opposite of that, but that's how I am. And you asked for my opinion, and that's my opinion. Limit your downside risk. Avoid as many gotchas as possible. The thing about gotchas is you don't know they're going to get you until they got you. Okay? You don't know if Microsoft, Google, Costco, Moody's, any of these companies are going to have a scandal. They're going to have, a cyber breach and all of their customer data gets revealed and then they go bankrupt. You don't know that. And so that's why, for me, I just take the safer route. And that's why I'm saying that. So it's maybe not what you wanted to hear, but that's what I truly believe. And I hope that it is helpful regardless. And thank you so much for sending over your portfolio. And shout out to Scotland. I have Scotland on my bucket list. I'm excited to. I want to go to Scotland. Probably not for a couple of years, but it's on my list. But Greg, thank you so much for sending over your portfolio. All right, let's take a look at the last portfolio from Matt. He writes, "My problem is time. I'm 45 and invested about $1,180 per month and have a net worth of about $176,000 with no real debt. I have $32,000 in a 401k, $60,000 in a taxable, and $12K in a Roth IRA. Since I feel as though I'm behind where I should be, that's why I invest in SCHG and a few moonshots like Rocket Lab, PL, Next, and Palantir. Near retirement, I'd like to put most everything into SCHD, VOO, O is Realty Income, or maybe your favorite DGRO, the Dividend Growth ETF from iShares. What should I change in anything to catch up?" And this is Brookfield is a shorter term hold, paying 9% yield. I plan on redistributing probably in a year or so. Well, Matt, thank you so much for sending over your portfolio. You're straight and to the point. You're anxious. You're scared that you might have missed the boat. You're late to the game and you need to catch up. You probably have seen these articles on CNBC about how Gen X is unprepared for retirement, that they're going to work until they're 70. And you probably saw that and you got scared, or you've seen your neighbor, your friend, who's in their 60s still working at the grocery store. This is a very common thing and it's scary. It really can be scary. the one thing that I do want to tell you is it's never too late. You could start in your 50s, your 60s, and you still wouldn't be too late. It depends on what you want in life. If you want a traditional retirement of millions of dollars and live on the beach, well, you're going to need to catch up. If you want to live a life where, a peaceful life, simple, where maybe you work a part-time job until you're 60, you can do that. There's no clear path in life that says this is the one way that you're going to be happy. You read all these articles, you see all these videos of people saying that this is why they're happy and this is the only way to be happy. I call BS. There's many different paths that can lead to success, and everyone's success is unique and subjective to them. So with that out of the way, yeah, sure, obviously it would have been better if you would have started when you were 18. You probably have learned about compound interest and how, you've wasted, quote unquote, wasted these last couple of years where you could have been living or doing something different. It's okay. You've now realized that you're 45 years old and you're trying to play catch up. Now, the very first thing that I would knock some sense into you is really, it's all about asking the right questions. You're 45 years old. What do you do? Now, the first question that I want you to ask is, well, what is your goal? What are you realistically working towards? Do you want the traditional retirement of 65? Do you want to retire in your mid-50s? What does this look like for you? Okay. And so based off of that question, if you say, well, I want to retire at 55, well, you're going to have to get very aggressive and catch up. If you want to retire at 65, you got 20 years, man. 20 years, it's 2 decades, right? You're probably going to experience 2 more great bear markets during that time period or more, right? 2, economic cycles. An economic cycle is 10 years, right? So you have a lot of time still ahead of you. It all depends on what you're trying to do. So you don't explicitly say in your email here what your goals are, but I'm going to assume that you're trying to retire by the age of 65. You want to retire at the age of 65 and you want to retire comfortably is what I'm going to assume. So this is what you want to first do is you don't want to just look at what you invest in, but where you invest your money. Okay, those are 2 questions that you have to answer independently. The very first thing is, where do you invest your money? Are you investing into a taxable or a Roth IRA account, a 401k? So what I would recommend is if you know you're going to retire after the age of 59 and a half, you want to focus all of your energy on your Roth IRA and your 401k. You want to max those accounts first before you invest any money into a taxable account. That is the first thing. Okay, now the answer would be different if you wanted to retire at 52. Well, if you want to retire at 52, this comes back to the question that we got earlier, right? Confused about time horizons. It all comes down to when you plan on living off of your dividend portfolio. So that's important to understand that it's not just your age, it's when you plan on living off your dividend portfolio. So now that we have that out of the way and we understand, okay, your first goal is where you're going to invest. You're going to max out your Roth IRA, max out your 401k first. And in those accounts, you're probably going to be limited to what you can invest in. In your 401k, I would recommend investing into the total US stock market or a S&P 500 index fund if it's available to you. Something with very, very low fees. Anything in a 401k, you want to first look at the low fees and go with a broad-based index fund. Don't focus on, bonds or anything like that. If you can help it, focus on a, low fee index fund that tracks the S&P 500 if possible. In your Roth IRA, you can get a little bit more creative. You could start investing into SHD, do a little bit of DGRO, something like that. That's the very first thing that you want to understand, where you're investing your money in. And then when we think about what you're investing in, you want to look at what your options are so that they can meet your goals, right? And your goal right now is to play catch up. All right, so let's take a look at your portfolio here. Now, you don't mention if this is in your Roth IRA, your taxable account. I'm just going to assume this is your Roth IRA because the majority of your money should be going into your Roth IRA. And HSA, if you have access to one, and HSA is great. So you got SHD, you got VU, you got Brookfield, Rocket Lab, you got SHG, Norwegian, okay, Realty Income, next, Palantir, Planet, okay. And you got some Bitcoin as well. So What I would recommend is I would take a methodical approach of this. I would use the core and satellite. If you are going to invest in individual stocks, I would take the core and satellite approach that I've talked about on my channel, where you have your core portfolio, which is made up of ETFs like you have today. And I would limit the percentage as you're doing, right, to 5% in individual stocks. And what I would recommend is have a balance of those satellite positions, right, that are not your VOO, your SHD or DGRO, is I would have a few growth ETFs that I've mentioned a few times in this video today. SHG, VUG, something like that, you can invest and it's not as emotional, right? What happens to Palantir or Next? There's a lot less boom or bust with these growth ETFs, but they still will help you grow your net worth, right? Like VGT and SHG, some of these growth ETFs, they double every 5 to 7 years, give or take, right? So if you have 20 years before you retire, before you reach the age of 65, you're going to be able to compound your wealth very effectively also with growth ETFs. So don't necessarily go to the roulette table or gamble your money away with these moonshots, because it's, in my opinion, it's just unnecessary risk. You can do that, but do it responsibly, do it with the core and satellite and limit your downside risk. And you do that by, limiting how much you have in those individual stocks. I personally would not have more than 20% of my money in those moonshot picks. I would not have more than 4 individual stocks focused on reaching the moon, in my opinion. I would have much less than that personally, but that's the maximum that I would recommend anyone. So that's just my opinion there. So in short, what I would recommend is you continue following, the core and satellite. You're maxing out your 401k. In your 401k, you're just focusing on the S&P 500. That's it. Don't play any games. Just focus on that. In your Roth IRA, I would have a combination of SHD, DGRO, and then I would have a growth ETF like SHG, which you already have, which I think is great. And then have, 20% in some of these individual stocks. And I would call it a day. And then what I would focus on is once you got that in place, then it comes down to, well, how do you make more money? How do you cut your expenses? How do you live below your means, right? How do you, stay out of consumer debt? And how do you get more money into your portfolio? That's what you want to focus on. 99% of the content here on YouTube, when it comes to finance, is about what stock to buy. What's the best stock? What you really, that can be important. What really will move the needle for your average person is understanding where to invest your money, understanding what to invest your money in, and then the majority of your energy should be focused on how do you cut your expenses and how do you make more money so that you can invest more and grow your wealth. That's what you want to focus on. Most people on YouTube don't want to hear that because that involves work and taking action. But in reality, guys, if you want to grow your net worth, you want to grow your wealth, and you want to catch up, you got to take action. You got to do something different. You got to put into action what you're learning, and you got to make it happen. So wishing your way and wishing that you're going to pick the right stock can only do so much. You really got to focus on things that will move the needle. Well, Matt, thank you so much for sending over your portfolio. I hope that this is helpful. It's maybe not what you necessarily wanted to hear, but hopefully it will give you new insight and perspective on how to look at this. But yeah, I'd love to hear your thoughts. If you haven't already, go check out Snowball Analytics, and thank you so much for watching, and I'll see everybody in next week's video.